This is Alan Mandel at HTDT Gold USA in New York, 75 Wall Street, with my Gold Journal report for November 27th, 2013. Gold started on a soft note this week, falling to 1223 before a strong rally Monday after the COMEX close. This shows that there's a lot of resilience to gold below the market, but it's very difficult to tell where the bottom will be as far as a launching point for a rally. Traders take maximum risk, but people who put away gold know that it's a wealth-preserving asset, nobody else's debt, and in the fullness of time will outperform everything else. This week, the main headline would be that manufacturing and consumer confidence remain weak in private surveys that have been released. Both the Mid-Atlantic and Chicago manufacturing surveys showed that this weakness is pervasive and it will continue for quite some time. The Mid-Atlantic manufacturing survey only grew to 1. 0 is the dividing line between growth and retraction. So 1 is a very weak reading. In the report, if you look in the report, it shows that the backlog for new orders dropped, hours worked and pay were down, and new orders were down also. In the Chicago manufacturing survey, Midwest, it also showed the reading weaker than expected. On the other hand, there are 3 big bubbles forming in the market that will explode at some time, driving down stock markets and causing turmoil in financial markets. There's a stock market bubble. The Dow is above 16,000. The NASDAQ is at a 6-year high, and prices don't seem to be really regarding price-earnings ratios and earnings potential very much. On the other hand, there's a bond bubble. Bonds are starting to waver. The interest rate on the 10-year note was 1.3% last year. Right now it's about 2.72%. So bonds are reacting to the possibility, and it's not remote, the possibility that inflation is going to creep back into the numbers, into the surveys, because the Fed has been buying bonds so much and printing so much money. The money has been going into assets, the stock market, the bond market, and also the high-end real estate market. Prices can't continue to rise 23% year over year. So any one of those markets could crack, and causing the Fed to continue on the gas pedal, printing money and buying bonds. The other aspect that has come to life is that the OECD in Europe said last week that they may push interest rates below 0. The United States indicated this week that the Fed may do that too. That means that depositors will be paying banks to keep their money. Would you pay a bank to store your money? You're not going to get any interest, you're paying the bank. People will see that it is irrelevant, and they will put away gold and silver as a store of value and of a protection of wealth. This could really start driving up the market. I don't know exactly when that's going to happen, but at under $20 for silver and around $1,240 for gold, it represents exceptional value. I'll be back next week. This is Alan Mandel, HTDT Gold in New York.